But when ASC 606 first came along, there's 5 requirements that we now have to evaluate in order to determine what and when to recognize revenue. So first is you have to identify the contract with the customer, then identify the performance obligations in the contract. So the contract with the customer for you guys obviously is the franchise agreement. And then the performance obligations in the contract, these are where your pre-opening services are. Is it one pre-opening, service, or is it 4? The expedient that I just mentioned lets you treat them all as one. Then you determine your transaction price, and then you allocate the transaction price to the performance obligations in the contract. And on the next couple of slides, I'll go through how this works specifically for franchisors. And then after you allocate your transaction price to each of your performance obligations, you then recognize revenue when or as the entity actually satisfies that performance obligation. So does the performance obligation get satisfied at a point in time or over a period of time? And it, depending on the question to those answers, is how you then recognize revenue. So identify performance obligations. This is kind of, for a franchisor, there's 2 performance obligations. One is the franchise term or the franchise right or license to operate the franchise, and then the other is your pre-opening services. But a performance obligation is a good or service that is promised to a customer. Each performance obligation must be distinct. It's distinct if both of the following criteria were met. So the customer can benefit the good or service either on its own or together with other resources that are really readily available to the customer, or the entity's promise to transfer the good or service to the customer is separately identifiable from others promised in the contract. And I'll talk about how this relates to franchisors. As it relates to franchisors, in pre-opening services, so your typical pre-opening services that you're providing to your franchisees are assistance in selection of a site, assistance in obtaining facilities and preparing the facilities for the intended use. That includes financing, architectural, engineering, any kind of lease negotiation, training of the franchisee's personnel or the franchisee, preparation and distribution of manuals and similar material concerning operations, administration, and record keeping, bookkeeping, IT, and advisory service, including setting up the franchisee's records, advising the franchisee about income, real estate, and other taxes or regulation affecting the franchisee's business, or inspection, testing, and other quality control programs. And so what the ASC 606 guidance kind of says is if each of these is considered a separate and distinct performance obligation, you would have to allocate a portion of your initial franchise fee across each one of these pre-opening services. But with the practical expedient election that was just passed in January of 2021, you can elect all of those to be one performance obligation and not multiple. So you must determine if you're not a publicly traded company, you can elect this practical expedient. So if you elect the practical expedient, you may make an accounting policy election to treat all of the pre-opening services as a single performance obligation, and you must disclose in your audited financial statements in the footnotes your revenue recognition accounting, the actual policy election that you are electing this and that you're treating your pre-opening services as one performance obligation. There is some footnote disclosure that's also required in the audited financials to make sure that the reader understands that the franchisor did make the practical expedient election. The adoption requirement for the practical expedient is you have to apply it retrospectively to the date that you originally implemented ASC 606. You also must restate prior year audited financials if you are issuing comparative financial statements, and you can show the impact of the adoption as of equity as of January 1st of 2020. And that would be if you were issuing comparative financial statements, you restate equity in the oldest year presented, which would be your 2020 year, if you're issuing comparative statements for both 2020 and 2021. So just an example, if you had an initial franchise fee of $25,000 and your franchise license term was 10 years, and then you had a sales-based royalty of 5% of franchisees' sales. So your royalty fees are very simple and straightforward. You recognize them as those monthly sales are incurred and you're owed those revenues. So you're recognizing those monthly at that point in time. The initial franchise fee is what you can potentially recognize either upfront or over the term of the agreement, but you have to go through these steps to assess whether you can first apply the practical expedient for identifying it as your pre-opening services as one performance obligation, evaluate to ensure that your pre-opening services fall in line with these that we mentioned right here on the pre-opening services slide. And if it does, if that answer is yes, then the entity basically has two performance obligations. One is the franchise license that happens and gives the franchisee the right to operate that store over, let's say, the period of 10 years. And then the second obligation is your pre-opening services. So you would allocate that $25,000 to your performance obligation and then recognize that revenue as your performance obligations are met.